Hi, and welcome everyone, and thank you for attending this webinar with SKAGEN M2, the Global Real Estate Fund. My name is Michael Gobitschek. I am the head portfolio manager on the fund, and today we're gonna do it in a known format. I'm gonna go through a short fund update, and I will share as well observation of the global real estate market and what is happening there, and what I believe will be a positive next 5 years, and why I think that. Of course, a lot of things are happening currently with tariffs, geopolitics, etc. So it's hard to get more than very vague conclusions from that. But I will try to do my best to at least address the things that are affecting real estate the most these days. But first of all, I want to just say a couple of words of M2 for those that hasn't listened before. This is a global real estate fund that invests in all sub-segments, in all geographies. We have try to obtain a long property-like return, is extracting the specific of real estate, meaning the inflation-adjusted leasings, etc., and try to obtain a balanced risk-reward profile. And what I mean with that is that we should not maximize risk at every cost. We try to take things a little bit differently and think independently, and not just focus on the real estate part. We also have a lot of focus on the capital allocation part and the ownership dynamics, to mention a few things. I think it's wise to remember or to remind the audience about the greatness of listed real estate. This is a picture of the US, 3.5 decades, or 34 years to be specific, and what we have seen. And it's important in these days when we have seen so much negative headlines and a lot of problems for real estate the last couple or 3 years actually. So this is from the US, the largest and the market that we have longest statistics, and it's 3.5 decades almost. So you have an average return of about 12.4% in US dollars. We have only reached 5.5% up till this year to date, or actually December 24. I have reasons to believe that we will close this gap to the average within the next 5 years or 6 years, and I will come back to why I think that, and over time also that we will see a positive development. One has to remind itself that we have just passed through an inflationary shock that we haven't seen in many decades, and the fast pace and the absolute numbers of the interest rates hikes that we have seen has affected real estate very negatively. Another thing that I want to remind the audience about is the transformation that we see in the real estate market today. This is the transformation that we have seen over the last 14 years on a global real estate universe. For instance, we have seen data centers and other alternative names coming into the universe on behalf of retail and office, for instance. So this is in constant transition, and this is also a thing that is easy to forget when you sit in Scandinavia or Europe, for that sake, because you don't have that much names to invest in as we speak, but that will change time. For instance, data center, you have some names now in Europe, but it's in its beginning. We don't have any in Scandinavia, etc. So it's good to remember that we have a palette of other assets that we can invest in on a global basis. I will follow up with a short fund update now, and let's start with the big real estate markets here and how they have performed year to date. So this is a little bit the opposite of what we have been used to the last 2-3 years, when we have had US as the prime leader in listed real estate. It's actually the worst performer this year, if we start on the right side. We have also and also affected by negative dollar development, of course. We have the pink or the peach colored bar is the real estate benchmark, and it's below 4%. Then we have Sweden, the cream colored bar is also -4%. And then we have MSCI All Country World, the broad index, the all sector benchmark has performed a little bit less than SKAGEN M2, which is the blue bar, is 1% in Euro terms. And then we have Asia, which has also been fairly poor performing over the last couple of years. What is happening now mainly is the emerging market. We have seen Hong Kong names has been performing well eventually after many years of desert walk. We have also seen a strong Japanese development, especially in Tokyo. On the left side is the black bar in Europe, and that we have been waiting for some years now with the return of Europe, especially as M2 is overweighted in Europe versus the US. What is happening here is as well that we have seen money flooding out from US, not only in other industries, but also in European names. We have seen, and I have shown that before, the relative valuation between US and Europe has been very much more beneficiary for the European names. SKAGEN M2 has performed about 6% since inception, net of all fees in the retail class. I have to remind you again, this is after some of the worst years that we have experienced in decades in terms of inflationary shock and interest rates levels and pace of the interest rate hikes. This year has been a fairly good performing year, so we are well ahead of benchmark as of today. What has performed well? We can see it on the left side, and here again, it's all about diversification. We have public property invest, it's social infrastructure, municipality houses, police buildings, educational buildings, etc. We have logistics, mainly in Eastern Europe, has performed very well. In terms of CTP, is Dutch listed. We have social infrastructure in Sweden, educational buildings, prisons, etc. Helios Towers is the tower company listed in UK, but towers standing in Africa and in the Middle East. Then we have our small position in the Vietnamese home builder that we have sold out after 135% increase this year. Also interesting to mention is the Swedish name Intea. They IPO'd in December 24, and they have about 90% performance since then. On the right side, the losing side, it's mainly US, and here it's also a big part of this is the currency. The portfolio is typically top 10 positioning around between 45 and 50%, is 47 today. We have 2 logistic companies. We have 4 digital real estate or / infrastructure names, 1 healthcare, 1 social infrastructure, 1 self-storage, and the largest real estate service company globally, which is CBRE. It's a good composition, and yeah, it's most of them has performed fairly well. On the right side here, we see the part that we are classifying as resilient, steady earners, the defensive growth names like data center on the top right. We have the towers, we have logistic names, we have the rental residential names, the manufacturing homes names in the US, the rental apartments, the student houses, healthcare names, and the social infrastructure. Typically, either they have long, fairly secure contracts, inflation adjusted, or they are in a subsegment that has structural demand that we see coming many years to come, like data center, like towers. On the left side, it's a little bit more risky side. Here we see, for instance, the new names within the US, the house building names, Toll Brothers, Beazer Homes, which is of course very interest rate sensitive, but the day when they start to cut the rates, those names will actually fly fairly well. We also have the European name Nexity. We also see here discount retail. We have some US retail names. Actually, US retail has performed fairly well over the last 24 months. due to the undersupply that we have seen coming and dried up over the 10 last year, because nobody has basically built any new retail due to the oversupply situation that we had 10 years ago. And we have the largest senior living in Brookdale, and senior living is fairly safe, but in this case we have put it there due to the owner dynamics with activists within the names that put an extra spice on this case. Okay, let's move on to the different categories here or sub-segments. We are still overweighted in digital real estate or infrastructure. We are in logistics and rental apartments, which we find interesting sub-segments to be in, depending on where we are in terms of geography. But also, interestingly enough, we have increased in healthcare with 2 new US names earlier this year. And that was a good timing, because healthcare has been the best subsector in the US year to date. Yeah, let's move on. We are not following benchmark. We are comparing ourselves versus a benchmark. So you can see that we are heavily underweighted still in the US, even though we have about 36% year to date. We are overweighted in Sweden, Britain, and Netherlands and Belgium, for instance. But it has also to do with the listing and not necessarily where all the assets are situated. We have always been very focused on the balance sheet, and we are still, and we sleep well on this balance sheet. We think the balance sheet here is very balanced, not to take on too much risk, nor to be too defensive. Interesting here is, and I will come back to that a little bit later, is that we have seen during the last couple of years, many companies has been repairing the balance sheet due to the elevated interest rate levels. So they basically put all the efforts there. But what we're seeing now is that they have more or less moved from that part over to the more offensive focus to grow instead of just repair balance sheet and to fire sale assets, etc. So this is very positive. And as you can see, our names has also been doing this, and it's a good level now. We are, as usual, a little bit cheaper than the benchmark. It has come up a little bit. This is mainly due to the digital real estate that we are referring to, a little bit more expensive than, for instance, retail names or the emerging market names. But we are still cheaper both in terms of substance, in terms of cash flow, and in earnings yield. The only thing, as usual, we are not better in than benchmark, but it's according to our philosophy, is the dividend yield, because we have invested in a lot of names with they are recycling their earnings into the company, and hopefully they will have a good return on investment on that money. On the other side, we have the higher earnings yield than the benchmark. Okay, that was short about the fund. Now I want to put some effort in the market and in the operating environment. And first of all, one has to address the elephant in the room and the question mark that we all ask ourselves, and it's hard to predict. It's about the tariffs and the outcome of that. Everyone remembers probably this spring what happened when tariffs became suddenly a part of everyday news. Everything came down, especially or even though those names that has nothing to do with the tariffs basically. But the interesting things here is what will happen in terms of growth, what will happen in terms of inflation and the interest rates, and that is hard to predict, but you have to relate to that in one way or another if you're in a very capital intensive asset class as we are in real estate. So this is important because of the I just want to mention this on the operational side. We have about 50% in the portfolio that are almost fully immune against the tariffs or semi-immune anyway. And I'm talking about the educational real estate, I'm talking about the self-storage part, I'm talking about healthcare, I'm talking about the social infrastructure, municipality house, police house, hospitals, etc. Has nothing to do with what they are doing in terms of tariffs. The ones that are building have higher cost probably, but could be in terms of towers or data center. But there you have such a strong underlying demand and trend at the moment, so that will also not be a very big problem. But on the financial side, that is what is harder to grasp, and it's of course about the inflation. And why is it important with the US inflation? Well, we have seen that, for instance, over the year in Sweden, that where I'm standing at the moment, the 10-year government bond has affected the Swedish real estate market basically more or less directly. So this is important, and not only in Sweden, of course. So what is happening now? Well, the red line here is what the market, or the experts, in this case 200 economists, predicted that we should be over the year at 2.7 in US about. Since the tariff discussion began, this has been revised upwards, so we are now at 3.2, 3.3, etc. Some believes that this is too high, the expectations, some because of the economy is coming down. Some believes it's too low. So we don't know, and we can speculate how much we want. But the matter of fact is that this is affecting the interest rates. So what is the market thinking about the interest rates and where it go, the policy rates, the banks' rates? Well, the fund futures, also here, economists that have projected this, will come down from 4.3 to 3.2. And this is a rational thought, because they haven't taken down the interest rate or cut it so much as we have done in Europe and Sweden. So trend here is, and point here is that it's probably coming down. In Europe and Sweden, we have cut interest rates several times already. And the interesting part is, of course, for the companies, what will happen with the cash flow when they renegotiating the interest rate levels. And that is something we are seeing as we speak now. But market is now believing from 2% in ECB and Sweden, we will cut another one time-ish before the year end. Sweden didn't cut the other day, but the experts think, and they are opening up for a cut before Christmas. So point here is, despite all the news and headlines about inflation, nobody knows where it will end up. The interest rate expectations is coming down despite all. If we look at the history, and this is no guarantee for the future, of course, but if you look at from the end of the 80s until now, when we have these rate cut periods, they can take shorter or longer term. It depends on where the economy is heading. US is now struggling on the inflationary side, or the salary side, or the unemployment side. Let's see what they're choosing, which side they should address. But one thing is clear: when we have this interest rate cut, it will be positive for listed real estate, because we have seen this historically. I've shown this before, and I think it's good because it has some history in it. And it's actually highlighting what is happening after interest rate cut. Private real estate, unlisted, S&P 500, broad benchmark, and listed real estate, the dark blue bar here. It's not the signal that they are cutting the rate that is the important thing here. It's actually what is happening in the P&L, profit and loss statement, the results. When we see this cash flow coming through into the results, and we see cash flow increasing, which is leading to higher valuation eventually, and higher room for maneuvers for the company. And now over to my observations. The first one is just about this. We have seen financing costs coming down basically all over the place, and it's much easier to obtain, both in the bank and the capital market through bond financing. And we have also seen the companies taking down their total debt, especially in Europe and especially in Scandinavia. In Sweden, where I am at the moment, we have seen a 200 bips or 2% lower debt financing cost since the peak 22-23. 200 basis points is a lot of money in a capital-intensive asset class as this. We can also see it at bottom left. This is not very fresh numbers, so actually this has come down as well since then. But for instance, in Europe, since the peak, we have seen over 100 bips cheaper financing. Please note that the US are not there yet because they haven't cut so much. So we will probably see that going forward as well, that we see this declined or better interest rates for the companies. They have also a president that is trying his best to get it done. Second observation is when you can borrow cheaper money and more money, you can also do transaction. You can start to lean forward and be offensive and not defensive as we have been for a couple of years now. We see this in transaction. We see this globally. You can see it on the right side. Transactions are increasing. Transactions, and this is monitoring direct investments over $5 million. And the sign here is very clear. Also, if we look at the listed real estate, we have the same observation on the right, 2024. It's increasing. We have a good example in the portfolio with our healthcare name, Aedifica from Belgium, is merging now with Confinimo and creating the largest healthcare REIT or real estate company in Europe. We have seen Swedish Pandox trying to bid for Dalata. We have seen Blackstone, KKR, and all these names being fairly active. So this is something that I expect will increase because this is also a good sign that they are confident with the future or hope for a good future anyway. And I think that it depends on the observations that I'm currently talking about now. So that will continue, and that is basically the oil in the machinery for real estate market. Third observation is the vacancy. On the left side here, we can see the vacancy on a global basis, but also separate markets, big markets, Europe, etc. And it's the overall vacancy, all the cities and all the sub-markets. So it's not only the CBD and the nice assets, it's overall vacancy. And it's fairly high. It's hard to make an assessment here that it's stabilizing the vacancy or declining. We can see that actually in Asia, but on the other numbers, it's harder to make that assessment. But we see that on a micro level. And we also see on the right side that the leasing trend is positive, especially in Asia. Again, they are 20% ahead of leasing pre-pandemic levels. So they are ahead, and they are much better off than before COVID. That was some sort of limit for office when you change the pattern how you work and use and consume office places. So this is positive as well, and we can also illustrate that from the US. This on the left side is also vacancy, but it's lower on office. Why is that? Why? Well, this is the CBD part, the nice asset, the grade A's, and etc. So it's lower. But you still have cities in the US where you have high vacancy, but it's coming down and it's stabilizing. New York is a good example. It takes some time, but the trend is right, and we see that in the cycle. And the consumption has changed somewhat in terms of how you use office. Here we also see industrial, retail, and municipality, stabilized vacancies. And why is this important? Well, the answer is on the right side. We have seen declining rental growth for some years now due to lower demand, higher supply, high interest rates, etc. But now we can actually see that something is happening now in the terms of rental growth. And this is, of course, very important for real estate. This is contributing to higher cash flow and higher valuations. And this is explained by this Very simple, but I think very good graph that one has to keep in mind, and it's about the cycle. The problem here is, of course, to make an assessment. Where are we in the cycle and how much time will it take before we move forward? What this picture is telling us is that we are in a recovery phase after a hard economical development or something else, high interest rate, inflation, etc. We have nothing built in many years because nobody afforded to build, nobody dared to build, and nobody asked for the new assets. So you have declining vacancy in terms of when you have a better economy, and the standing assets are filled up first. Times are passing, and now you can actually do the equation and start to build and construct new things. They are coming into the market, it's absorbed, times typically change, and economy it goes from good to bad or worse, probably a recession, and then increasing vacancy follows. So this is about supply and demand. We can see how it looks actually in real term. This is construction starts in the US in different subsegments: industrial, multifamily, office, and retail. The peak was 2021, after COVID, when everything was opening. That was the heyday, right? So a lot of constructing companies started to build. It takes some time. You have some lag with permits, etc. So it takes some time before it's finished. Here was a lot of construction starts. And now, a couple of years later, there are basically no construction starts. Also, the things on the below graph that has been in the pipeline are vanishing. And so not much in the pipeline, not much starts to be built either. So what is happening with the supply? Well, the supply is shrinking and dries out, which is beneficiary for the standing assets again. We can see that here as well. I think this graph is very good. It's North America, Europe, and Asia, different subsegments. What is this showing? Well, it's showing that 2025, this year's forecasted completions, meaning assets coming out on the market, versus the peak 21 to 24. And it's all negative, especially in the US. There is a couple of positive notes in Asia in terms of retail and hotels. But the things that sticks out here on the right side is data center. They're actually way above. So what does this mean? Well, it means my fifth observation, that there are segments that are doing very well, despite all the headlines that we are seeing, despite all the, for instance, in office, for instance, in that nothing is constructed because nobody can afford it, it's high interest rate, etc. Data center is performing like there was no tomorrow, and this is just the beginning as well, as it seems. This is an interesting graph, a little bit showing what I just talked about, the construction starts. So data center will surpass general office within a couple of months now in the US. And this is a big thing because office is the most traditional asset class and one of the biggest as well in terms of global real estate. And why is this? Well, of course, it is about big tech. Not all about big tech, because there are other companies also that has a demand for data center, for instance. But here you can see the revenues that drive these investments in data center. It's mainly about the cloud business, but now we start to see adoptions versus need versus the AI plus the cloud. So AI comes on top of the cloud bulk that we're seeing now. What does this mean for me? Selling the shovels in the gold rush again, because we are buying into the data center that are constructed or the data center that are owned, but we have nothing to do with the operational part. That is the Microsofts and the Amazon, etc. So we are doing the real estate, we're investing in the data centers in different ways. Interestingly enough, on the left side here, in first quarter this year, there were a big bump in beliefs of the spending on this type of investments. After DeepSeek, for those remembering that, after tariff discussion, etc., everybody thought, or the market thought, that this is the end of CapEx spending. But 1 quarter later, it couldn't be more wrong. The CapEx amount has increased and surpassed what they thought before the first quarter. So that ends up with about $394 billion for this year, and $460 billion is so much money next year. Let's see what's happening, but this is actually communicated levels, and it could be more, it could be less. Why is this important? Well, we invest in a real estate asset class that has rental growth, also hard to assess, years ahead, because this takes time to build. It's not a shed, it's very expensive. It requires you have to be allowed to build it, and you have to have power in nearby, etc. So much, and it's very complicated. So this is something special with this asset class. But we see demand is surpassing the supply for many years ahead, which is interesting. So my point here and my observation is there are asset classes, there are places geographically that are performing well despite all the negative headlines, and one should not forget that. Sixth observation, of course, is the valuation. This is relative valuation, price to book and price to cash flow, substance and cash flow. Here we can see clearly that real estate is much cheaper than all the other segments or sectors. And this also has an historical implication, because it hasn't been this cheap in many, many years. One could argue that everything else is very, very expensive and real estate is just expensive, but we can lean on the absolute valuation here. And in terms of global real estate, we're trading below the historical average on substance. But also worth to mention, it depends on where you look, and it depends on in which sub-segment you look, etc. One can look at a little bit closer here and typically show US and Europe to be major market with a big gap between them valuation-wise. We see Europe is trading about 26% discount. US is trading at on par with net asset value. In terms of cash flow, below graphs, Europe is trading at 13, US at 16. But please remember here that Europe has started to cut their interest rates, so they are coming through the P&L already. So all else equal, this means that this multiple will come down when the renegotiated lower interest rate levels hits the P&L, as we see at the moment. Let's boil this down further. I took this the other day from Swedish market, which is not uninteresting because we have overweighted in Sweden, but it illustrates the example that I'm referring to. If one believes that this discount to the net asset value will shrink over time due to higher cash flow, which is the dynamic actually. On the left side, we see the net asset, we see the substance. It hasn't been this consistently discounted as long as for instance, the inflation shock recently and the grand financial crisis. So this is still cheap material, right? So if the discount is shrinking, one can see the simulated effect on the stock price on the right side. And this is what we believe will happen over time. If history is any guidance, and if one do its calculation due to on the profit making they are doing and the growth they are actually having before them. So over to the outlook, just to summarize things. Valuation is relatively very cheap. In absolute terms, also cheap to history, depends on where you look, and in terms of geography and subsegment. Inflation, we don't know where that is going, but still interest rates are leaning towards south anyway, rather than north. But we have seen it before. We can dance a little bit aside, forward, backwards, etc. It might take longer time than we think, but eventually gravity will have its path, and it will also lead to lower expected rate of returns, meaning higher values on real estate. We have already seen this in Europe and Sweden, for instance. We have seen that historical performance is positive when we have interest rate cuts due to the lower cost of capital, and lower cost of capital is also meaning that the focus on growth instead of balance sheet repair will continue and increase, which will lead to higher transactions and more M&A activity, which is very good for the real estate market due to valuation. We got valuation. We can get the valuation multiples, but also it works like the oil in machinery for real estate, and it signals that you can still do good deals with a decent price tag. And this comes from also construction slowdown, supply dries out, and demand is increasing, depending a little bit on where the growth is going due to the macro situation or the geopolitical situation. But typically the cycle is followed, and now we have a lot of undersupplied segment, which should lead to standing assets as declining vacancy and start to see rental growth, which is also positive. The warning sign here is, of course, if the inflation is blowing up again, and things are happening geopolitically, etc., because it is already very macro driven as of today. So that is something that is typically moving the markets. A good example of this was the tariffs, when everything came down, even though asset that didn't have anything to do with the tariffs came down as much as the import and export companies, and that is wrong. The markets sobered up and realized this and traded up thus again. Movements like this, I think we will have that, but eventually market will look at the underlying assets and what they are representing. In my case, it's real estate. We have long foreseeable rental contracts, so real estate is typically good to have in stormy markets. That's all for me. Thank you very much for listening. Look forward to meet you next time again. Have a nice day.